Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday, and it's July 6th. Hope you guys are having a great morning thus far. We got a bit of data come over today. Today's actually a big day because we get the jobs numbers. So let's kind of jump right into it. We'll start off, of course, with the biggie, the non-farm payrolls for the month of June. This is brought to us by the BLS, or Bureau of Labor Statistics. So the previous month, last month in May, came in at 244,000 new jobs. Forecast was about 195,000, and it came at 213,000. Now, the previous 2 months, April and May, was actually revised higher by 30 total of 37,000 new jobs created. So this, of course, is looking very good here. Now, however, we got the unemployment rate for the month of June. We had a 3.8%, and the forecast was supposed to continue at 3.8%, and it jumped up 4%. Now, the reason being is that we have a higher participation rate. We only had about 100,000 new jobs and about 600,000 new participants joining the labor force. So that's what made the jump there. But still okay. Still we're in very good levels here. And then some other good levels here is average hourly earnings. So for the month of June. So in May, people had to see sort of on average saw an increase of about 0.3% in their average hourly earnings. We figured we would keep on that same pace at 0.3%, and it went up only 0.2%. Now, the reason why this is kind of good is that it's showing that wage inflation is very tame right now. It's not like getting out of hand, and that's what's been kind of concerning people or the investors previously, because if it's going up too dramatically, it's going to create too much high inflation. Of course, it's going to result with the Fed continuously raising more and more rates. We are expecting them to raise at least two more this year. We know for sure September before June's FOMC, December was a 50-50 chance, and then after that meeting, it looks like it's pretty much much higher percentage that they will hike in December as well. So we'll have a total of 4 rate hikes this year. Now, last but not least, we got average hourly earning or average weekly hours, excuse me, and for the month of June. So basically across the board, it stayed the same at 34.5 hours. Now, this is important primarily because sometimes people will go ahead and work their employees more hours when business gets picks up a bit. They'll have people work more hours, so they don't have to pay them more money, and this stayed across the board. So it's not getting out of hand here, which is what this is just telling us. Now, stock market is up. It's like in those job numbers news. Also, well, midnight East Coast time, U.S. imposed their 34 billion tariffs, and of course, China, a different time zone, responded the same way on tariffs. So we got that there. Something I didn't note on there was pretty interesting. The just before around May, the tariffs came in place. The trade deficit basically came in at, it dropped by 6.6%, and I think a lot of it had to do with reserves, shipments taken in before these tariffs kick in, and that's so we actually it dropped by 6.6%. So that was kind of good news as well. We'll see how this plays out with the tariffs, but the trade deficit shrunk a bit, even though we're on pace still for a record for the trade gap that we've been experiencing. So we'll see what kind of role these tariffs play with the trade war and such. So let's kind of take a look to see how the bond market is reacting. Now, typically I don't show this bottom part, the stochastic. This is a stochastic meter here, and as you can see, we are breaking above this 100-day moving average and this double layer here of the Fibonacci here. This is usually a pretty tough layer here, but it's not real convincing. You know why? Because we're actually in a overbought position right now. So when we go above this on the stochastic meter here, we go above this level here, at some point it's going to reverse. Like we saw here, we went way up here, we reversed, and we went back down below in neutral territory here. Now when we go below here, we're kind of an oversold position, and then we kind of climb upwards, just like we saw over here. It was oversold, and then climbed upwards. So now we're going to be seeing this here in this position where that's why I say be very cautious, as in if you are in a transaction, refinance, or purchase, you may want to start looking to lock in sometime soon and take advantage of these gains, because how much more of this, I'm not sure if we're going to see much more height in this as again we're getting in a oversold or overbought position right now, and it'll have to be sold off to bring us back into more of a neutral territory here. Same thing over in the 10-year Treasury here. We got a lot of room here back and forth, but we're kind of going in right below this level as well. And it'll at some point it'll switch around with the yields start rising again. All right, so interest rates are about the same as where we left off yesterday, so that's a good sign here. Rates are, we're only up about 3 basis points. Treasury's about the same at 2.83, so there's really no difference in pricing today in terms of all this. But the good thing is that's a good news, primarily because when we have good news in terms of the stock market, we're usually competing for those dollars, and we could have been in a much worse position. So far, good day so far. But again, be cautious and have your loan officer be quick on the trigger in terms of locking if you are out there. All right, so that pretty much wraps things up. But I will be posting throughout the day. If you want, just stumble over to Twitter. You can find me at Mike Bjork. I do post throughout the day. There are different market updates. So stay tuned. You guys have a great rest of your day. Enjoy your weekend, and we'll see you guys on Monday. Thanks for watching. Bye bye.